Good morning, traders. It's Friday, May 9th. Hopefully everybody has a great weekend. In this video, I'm going to cover on a few interesting things. We had a couple comments about covered calls and hedged ETFs. So I'm going to show you how bad those really are. I'm going to touch on real estate. Get ready for the bottom to fall out in the real estate market this spring and through the summer. I'm going to talk about show you some interesting comparison charts of 2008, and I'm going to bring in bonds and inverse ETFs and show you where some of that potential lies. And I'm also going to cover about how I'm always bearish. There's a comment about how many months or years have I been bearish on the markets, and it's funny. I read some of the comments and people are there's lots of trolls out there. I am bearish. It's better to be protective and know things could break apart, but we don't trade what we think, feel, or want to happen. We still follow the market. So we've been following this market up. We trade rallies. Even if I'm bearish, it's just to be prepared knowing things could unfold. This time, the data right now is so strong that it looks like we are entering not just a bear market phase, but a financial reset. Similar to the 2000 tech bubble, similar to 2008. I think we're going into something very big. And everything is aligning, but it doesn't mean it's going to happen, and it doesn't matter if it happens because we follow price. So I touch on that, and I touch on gold. Last but not least, I show gold. I show an angle of it that I don't think I've actually shown, and a forecast I've never shown for gold either. So make sure you stay tuned and check it out. But let's jump into the charts. We have equities trading slightly higher this morning. We've got the S&P 500 up almost 0.3%. The Nasdaq is up about 0.4%, and the Russell and the Dow up about 0.2. So a little bit of a positive morning. Obviously, a little bit of shake up this morning, a little bit of price action around, what time is that? That was 7:20. Some type of news came out, created a little bit of a blip on the chart. But overall, the market is holding up. And yesterday, we did end up having a little bit of FOMO in the market, which when we get a little bit of FOMO, it typically means we're going to see a little bit of a pullback. And we did see that into the closing bell yesterday. The market did have a quick bout of selling, and we have been seeing that more often than not. Recently, usually we see a wave of selling into the closing bell. Some people moving out of positions, trimming off positions, institutions potentially trimming off as the market drifts higher or goes higher here. They're going to be unloading portfolios. It's somewhat like distribution selling. We've talked about how the market's going to try and go up here and become bullish for the general masses to get excited, and for the general market participants to buy. And of course, they're going to sell large loads, usually at the open and usually in the close, when there is lots of volume and liquidity for them to dump chunks of shares. And we see it throughout the day, intraday wise as well, the odd big block of shares being sold here and there. So overall, again, the market is testing. If we look at the S&P 500, it does have a little bit of a bullish pattern here, looking like it wants to push higher. It is stuck kind of at this resistance area. If we take a look over at the Nasdaq, we have it is trading a little closer right up to these highs as well that we saw back in March. And so it does have a series of little bull flags and looking like it wants to push and try and go a little bit deeper into this dead cat bounce. I think if we break these highs on the S&P 500 and the Nasdaq, we're going to probably see a bit of a short squeeze. I think there's a lot of people probably betting on falling prices. And if this starts to break this high, we're probably going to see a lot of shorts cover and create a little bit of fuel for this to push higher and squeeze up a little bit more. Now, I do want to touch on a bunch of comments before we get actually into a little bit more. We had a comment about, I'll pull it up here with this one here, about covered call ETFs. I'm going to, if I pull up a covered call ETF, we can take a look here. I'm not a big fan of covered call ETFs. Brian and I have touched on this in our mentoring sessions. We didn't talk about it yesterday in our live mentoring session, but in the grand scheme of things, these generally aren't very good. If we go back in time, if you look at the price action, this is going back to where? This is going back to 2018. I just took a random one. Nasdaq has been ripping to the upside, and the covered call ETF has been going down and to the right. Just for example, if we just take this level here and we go to where it is right now, the Nasdaq more or less up 159%. And if we were to take that same point here and go down about 35%. Now this does pay pretty decent dividends because it's selling, it's doing covered calls. So it does yield about 11 to 14% a year. But overall, again, it still struggles a lot. And if we take a look at the grand scheme of things, let's just clear a few of these up. I'm not a fan of these. Typically when the stock market goes down, it still gets hit. If we just take a look at this market rally right here, this is about a 2-year move. The Nasdaq's up about 42%, and if we go to the same point here, you're pretty much flat, and you would have made about 15, 20%, somewhere in there, depending on how it unfolds with the covered calls. But again, when the market crashes, you'll tend to see these still sell off, and everything pretty much gets hit. If we just look at where it is right here, down about 10%. If you look at this into where it is now, down about 12%. So it doesn't really protect you. It pays you some dividends, but again, in the grand scheme of things, if the market is falling, you either just covered calls and hedging are just expensive. You're better to just step aside and earn interest with no risk, or bet on falling pricing and let the market fall and move up with an inverse ETF. So this is the same with pretty much most covered call ETFs. They're just not the greatest. They're a fancy way. They get sold as a really good tool and a hedge and a way to protect yourself. But again, when the market falls, everything falls. You're better to just move aside, avoid the fall, or actually bet on the fall. And you can do that by understanding the trends and taking advantage of it, which is kind of what we focus on. The other thing I want to just quickly touch on, I had a couple interesting calls yesterday. And some of them were based around real estate. I do feel like we're on the cusp of real estate having a pretty big drop. More or less this kind of topping phase here in the average price of single family homes is really kind of roughly from about 400,000 to, it goes way up here to 460 or 455, somewhere way up there. It's a big push. I think we're going to find out this March. I know a lot of people trying to sell homes. I talked to somebody in California. They can't sell it. They tried to sell their house in Florida as well. The same couple, same person, and she couldn't. They never got any offers either. And I've heard this over and over again. So I think once things start to sell this spring, I bet you we're going to see this housing market drop about 10% fairly quickly. It's just going to have a very sharp drop. So if you are looking to get into real estate, especially in the Florida area, I think you're going to see about a 10 or plus % drop probably in the next few months. I think that it's going to be pretty interesting there. Let's take a look at an interesting comparison chart. So yesterday in the live mentoring session, I had showed a comparison chart of how the 2008, so this is the S&P 500, the weekly chart, how the 2008 market top went into this 57% sell-off. I compared the dollar and gold, and one of the members was saying, can you also show what happens with TLT and also with an inverse ETF through this phase? And this is what I always struggle to try and show. And I think hopefully these charts will carry this over. This is what I teach in my book. It's what we cover all the time. And I don't know if it always gets through because it's not easy. There's a lot of moving parts. It's hard to follow everything I say because I'm all over the place. But let's take a look. This is the 2008. You can see here, 2008, 2007 market top, and the stock market fell 57%. So let's take a look at a couple things. So right now, this yellow line is gold. And when the stock market, typically when the stock market starts to stall out and gold starts to shoot higher, that is usually a warning sign that the economy, something's about to shift. There's concerns, there's uncertainty, there's war, whatever. There's usually a whole bunch of stuff stacking up. And then eventually the stock market starts to break down and we see gold continue to move up. And then gold might go into a bit of a bounce, a dead cat bounce type of thing. And gold can continue to push higher as that defensive play. But eventually the stock market goes from a bullish phase to it triggers into a bearish phase. And gold will hold up a little bit. for a month or two. And then eventually the stock market starts to roll over and it goes into this bearish phase. And when there's lots of fear in the market and panic selling, it pulls gold down. And gold fell 34%. Now, gold will generally bottom we've seen in 2008, months and months before the stock market does. So when gold starts to put in a bottom and rally, that'll be our early warning sign saying, hey, okay, I think the stock market is going to start to put in more of a bottoming pattern. Now, this is kind of where I believe we are. We've had this first bout to the downside. A lot of fear has hit the market. People are searching for, thinking bear market is kicking in. Our strategy has kicked into a bear market. If we take a look here, you can see we have kicked into a bear market just about a month ago. And we're going into this dead cat bounce kind of scenario from the looks of it. Let me pull this chart back up. And of course, gold has been pushing to all-time highs. I do believe gold now may have put in a top. I mean, I wouldn't bet against it yet, but it definitely has had its move and it might want to push a little bit more. But eventually gold puts in a top simply for a couple reasons. The selling pressure in the stock market starts to go negative and people start to sell everything and it pulls gold down. But we tend to see the dollar shine during chaos, global chaos and uncertainty. And this green line here is the US dollar, the greenback. And of course, the greenback put it in a bottom. It was sold off. It was one of the most hated, currencies at the point. And nobody wanted it and everybody wanted gold. And that's the scenario we're at right now. The dollar has taken a beating. Everybody says it's dead. Fiat currency is going to crash. And that's what they've said ever since I got into trading in 1997. And of course, everybody wants gold. But, now we've got the dollar putting in a bottom and it starts to firm up. And then eventually, as the stock market crashes and pulls gold and everything down with it, the dollar tends to shine and tends to rally up. And of course, a rising dollar also pulls gold down in US dollar terms. So that's kind of the correlation where we are right now. Now, the other person wanted me to bring up bonds. They want to see how bonds do. So take a look at the chart of bonds. Typically, bonds will move up a little bit as the stock market moves down. Now, this is the typical rising interest falling interest rate environment. But bonds really shine when actually, this collapse hits and then finally the government, the Fed and all that panic and they start dropping rates. And when they start dropping rates, bonds shoot up. So bonds should hold some value, but they won't really spike until near the major market bottom. And of course, it will pull investors into bonds after it starts to rally and take off. And if we just put the 10-year yield on here, the white line, as rates start to fall and they cut rates to try to save businesses and save the economy, of course, bonds go in the opposite direction. Now, there is a way to kind of play this instead of playing bonds for a very quick spike, which is an opportunity. The other way to do this is this purple line, which is an inverse ETF. So as the stock market starts to go down, the inverse ETF goes up. And this is where we can take advantage of breakdowns in the market. When the market goes from a dead cat bounce and rolls over and has this downward draft, we're able to play these upward moves. And then it pauses and then it starts to roll over again and gives a new downtrend. That's where we can get in and we can try and play another one of these moves. And typically you have a few of these, 2 or 3 of these in a bear market phase that are tradable. And then and potentially even one over here. And you can play these upward moves. So there's some multiple opportunities in a bear market to take advantage of falling prices. So this isn't hedging. This is just betting on the economy collapsing, betting on falling pricing, and just going for it versus trying to do covered calls, trying to hold on to gold. People keep asking me about, can I move into international stocks? As we know, international stocks just get clobbered. If we take a look at, they're all related. Let's just go to the monthly chart. This doesn't really go back as far as I want it to, but let me just go to the daily chart. The general rule is, here are the US indices. Here's the Nikkei, Euro stocks, the DAX. Pretty much when the markets are crashing and selling off, they all sell off together. Now, some might rebound faster. Some might not start to crash until the real wave of panic hits, and then they'll pull back. But when we're in a bear market that lasts months or years, they all get sucked down together. They're the same trade. Stocks are stocks when there is panic or FOMO. They all rally together when everybody's on board, and they all sell off when everybody's freaking out. So that's kind of that scenario. So if we just go back to where gold is right now, this is 2008, and we've got gold shooting up to all-time highs. We had this first big bout here of kicking things into a bear market phase. If we take a look at what 2008 did, so the top chart is the 2008 chart we're looking at. This is the monthly chart. We had that first big bout of selling that I was just showing you, and there was a big spike on Google of everybody searching bear market. And we've just had the same with the stock market where we are now. Big bout of selling. It has flushed down. It's hard to see. There is actually a lower wick down here. We did have a bigger drop. It's trying to go into what I believe is this kind of dead cat bounce. It's bouncing up and could move over for a month or two. But overall, we're had a very similar scenario where gold has, just like in 2008, gold has shot up to new all-time highs. Gold here has shot up to new all-time highs. We've had the first big breakdown and wave of selling in the stock market. We had the first big spike of everybody thinking it's a bear market. And again, just as I mentioned, I think the other day, just because everybody's searching for a bear market and the sentiment that people read from all these online graphs saying that the masses are all bearish, it's a super high level of everyone's bearish, and that means the bottom is in. It does not mean that. It really just means a lot of people are bearish. And this cycle that's coming into play is huge. The best example is like the ocean tide. I always try to relate the stock market to the ocean. If we all know the tide is going down at lunch today, it doesn't mean the tide is not going to go down because we know about it. It's going down. It is a cycle. And these financial reset cycles, these are huge global cycles that seem to be at play. Now we'll have to see how all this plays out. But at this point, the cycle seems to be on the downswing globally, and all this particular asset classes are stalling out. Economic data is slowly shifting and pointing to a big financial reset. So again, I might be proven wrong, but it's better to be prepared and to see this unfolding. And if the market does turn back up and go into another bull market, it doesn't really matter because we'll be long the market and we will ride it higher because we follow price. We don't follow what I think, see, or feel. We just follow actual price itself. What else was there? There was another comment about somebody talking about how many months or years have I been bearish? I've been bearish for a very long time. I was bearish going into, let me just go back to the markets here. I was bearish going into obviously I was bearish going into COVID. All this market was starting to stall out. We were seeing all kinds of signs of extreme pullbacks. We saw the utilities sector outperforming dramatically, telling us an imminent pullback was happening. And anyways, I've been bearish for a long time, but it doesn't mean we trade that. And this is, I think, the big disconnect is just because I'm kind of like always talking about a major market top unfolding doesn't mean that's what we trade. And that's the disconnect. So anyways, let's go back to the rest of the market real quick and see what else is moving here. We do have the dollar down a little bit this morning. We have gold up about 8%. Gold's had a quick pullback. It's down to the 20-day and kind of a support level here, trying to find a little bit of a bounce. We do have oil up again today. It was up 3%, I think, yesterday. It's up 2% now. So it's having this bounce, this little bit of a double bottom. It is pushing back up into an overbought market condition. You can see here this SS. So it's definitely running in. It's in a downtrend, and this is kind of an overbought market. It might end up getting pulled back and sold down a little bit. What else do we have? Bitcoin had a nice push and pop yesterday. It's up again about another 1.5% today. It did hit our band target. We hit our first target there yesterday, closing half of our Bitcoin position. So we've closed out half our position in both in gold, Bitcoin, and our URA, our uranium stocks this week. So those are all now just kind of free trades. We've locked in profits. If they reverse to our entry price, we'll just get out. But right now we're just kind of riding these. And if this market does pop and have another push higher, we're going to see probably Bitcoin and uranium stocks have a really good push. Gold does have a bullish pattern here on the short-term chart. It is flagging sideways, and again, it could push up to 37.50, 37.75. I can't remember what that target was, but it has potential to keep moving higher. Last but not least, one of the members was asking about, they were confused. Actually, I think a whole bunch of you were confused on my gold analysis. So try to bear with me here, guys. Here are my 3 different views. I like to break things down into 3 time frames because 2 I find is not enough. I believe here's the longest. I wouldn't say this is long term. I would say this is the super cycle view. So we started a new super cycle in gold back way over here, and it had its super cycle wave up into 2011. Now, in the halfway point was the financial crisis, 2008 market top. Now, we had a new super cycle start here in 2019. I believe we're going to see gold, scream higher. Let's use a Fibonacci extension. So I believe we are going to see gold. If this is a top, it could pull back somewhere down to, let's just say 2,600, somewhere in here. This is going to give us our Fibonacci upside targets. So if you look at this as a long-term super cycle, not just a bull or bear market, this is beyond that. This is a bigger cycle than that. We're looking for something for gold to go up to here. That's 5,100 roughly. Here is going to be the financial crisis, the pullback, just like we saw over here. And then of course it will potentially run up and go a whole lot higher. So very, very long-term super cycle where I'm super bullish. As a bull market, bear market phase that can last, a year or so, somewhere in there, I am bearish. I believe we're going to see gold pull back. As a short-term trader, which is why we're long gold right now in our short-term strategy, we're playing gold and it has a bullish chart pattern, and it is pointing to, just based on the most recent price action, it is pointing to roughly 37.50 to the upside. It has this is the most bullish pattern here. It's flagging out, and then it could go up to here. So crazy long term, very bullish. If you're just an investor thinking about what's going to happen by the end of this year or next year, gold's probably going to be negative. If you're just looking at this as a trade, gold should hold its value or push higher. That is what the analysis is. So hopefully that breaks down the views, the 3 views of kind of how I see the gold market. All right. Anyway, video is super long today. Sorry about that. We'll pull the plug and go from here. Talk to you later. Bye-bye.